Merci.
Thank you very much, Florence, for this remarkable introduction. And as a matter of fact, I intend to discuss with you two topics. The first one, why the monetary policy in the past few years, why is it the subject of debates? And secondly, what are the consequences on the productive investments of very low interest rates and even negative, which are at the forefront today, especially in Europe? So, why is the monetary policy in the past few years the one which was called unconventional but has become ultra-conventional? Why is it the subject of discussions? Remember, it is in order to fight against the crisis of 2007 and 2008 that central banks decided to untighten their policies. However, too much debt seen in the 10 previous years before the crisis had shaken up the financial system. And when the bubble of subprime loans and many others burst in 2007, the whole system became gripped. Too highly indebted companies ran into difficulties and required restructurings. And then investors who were concerned about the fate of their assets and looking for cash started to sell in a defaulting market, and there was a dive in prices. Large banks, some of them too much exposed to market risks, needed the support of public authorities. So it is against this dramatic context that central banks stepped in as financiers of last resort. They bought back securities and provided massively the liquidity that was escaping. So these banks played a crucial role to avoid a social economic disaster that could have resulted from such a crisis. However, let's not forget that the origin of the crisis, in other words, too much debts amongst economic agents, came from the lack of credit control through the monetary authorities and the asset bubbles that they had let inflate themselves. Central banks therefore supported the economy after having shaken it up and bought financial assets. As a matter of fact, the balance sheets of these institutions exploded. They were multiplied by 4 on average. However, what is also important to note is that central banks decided also to go on board later on of a non-conventional policy of QA, of quantitative easing after the crisis. Therefore, the Fed launched 3 waves of quantitative easings in 2009, 10, and 13. It was a systematic policy of buying securities in order to bring down interest rates across the whole curve of the rates. Therefore, there was a very much higher prices of bonds came and a deep decline in the rates. This monetary policies by the Fed prevailed onto the whole world to the extent that the fact for a central bank of not being aligned with the Fed policy would quickly have been punished by the higher currency, which would have created competitiveness-related problems. So these buyback programs were massive, such as in the Eurozone. The European Central Bank bought nearly 60% of the total issuances of public securities at the time, and they were extended over a very long period of time. And it is the duration of these programs which I believe is raising the highest number of problems and the biggest intensity of problems. Whilst the Fed in the US decided to stop QA in 2017 and in 2019, when the increase in rates was interrupted again, the ECB maintained its buyback program whilst growth was picking up again in 2017, 2018. And I believe they should have more normalized this rate policy at a time where this extreme QE could no longer be warranted. It's important here to open a methodological bracket, which I believe is essential. The Fed and the other central banks decided, well, more than 20 years ago, to set an inflationary target, which was set at just under 2% for consumer prices, but that 2% figure, which probably was valid about 20 years ago, no longer corresponds to today's reality. As a matter of fact, several structural factors play against a reduction of long-term inflation, especially the aging of our societies, and Florence alluded to that, the opening of international trade to imports with very low wages, and we can add to this change seen in the jobs market, as well as productivity gains coming from new technologies. All these factors account for the fact that structural inflation, the one that avoids deflation or hyperinflation today, is around 1% and not around 2%. And this does not include any problems because prices continue to increase, and the specter of deflation is not to be feared. In a certain way, the purchasing power is supported even better if you have lower inflation. However, the fact of setting the inflation rate at 2% against a more realistic figure around 1.5%, led to an expansion of the monetary policy, wanting at any cost of bringing up the inflation rate at 2% through the play of monetary policy, as a matter of fact, led to very, very damaging consequences. Let's analyze in a few words now the weaknesses promoted by this so-called unconventional policy. First of all, it promotes debts, which had been the cause of the previous crisis. Remember, the global debt of non-financial agents in the world since the crisis of 2008 has risen by 80%, moving from $5 to $9 trillion. Secondly, it could generate asset bubbles, and which is the case of shares, stocks, bonds, which have strongly been appreciated by following the quantitative easing events. Thirdly, such weaknesses strip out a little bit from the interest rates, the discrimination between signature, the divergences of risk cannot be found in the spread variances, which are compressed through an action by the central bank. It also weakens the banking system by eroding its interest margin. And it's, after all, the banking system which is the main driver of the monetary policy negative rates taken, for example, by the ECB on banks' reserves from the central bank. These are mandatory reserves for the most of them, spur them in a way, to pass along that tax on the people who deposit the money. It also raises a solvency problem with regard to the pension funds and insurance companies in regard to long obligations, quite often based on contracts with a guaranteed yield. These bond assets of these insurance companies practically have no return for them. This is a source of weakness that insurance companies have to manage by increasing their equity, by diversifying their investments towards less liquid assets, or by adjusting their business model towards other sectors and the finance. However, Solvency II, which unfortunately is indifferent to the fit between assets and liabilities in terms of duration, and the lower return of bonds raises an essential problem for these insurance groups.
J'ajouterais que cette politique.
So in regard, this policy promotes the long-term existence of so-called zombie companies, which due to zero rates can still survive, and put the brakes of market shares of more innovative companies. I would like to add that it accustoms states not to have to turn around, not to see as a priority the turning around of their economies. It prompts also investors to look for more rewarding returns, search for the yield, and therefore make more riskier investments in this regard. The alert was the warning sent a week ago by the IMF and its new CEO should be taken very seriously. The global economy is, according to this warning, is vulnerable to a backlash, and by central banks promote short-term, but at the cost of the financial system, the non-banking institutions such as pension funds, investment funds, hedge funds, the non-banks increasingly invest in non-listed shares, in triple B debt, or in CLOs, or may well suffer major difficulties when a number of companies which are too exposed run into problems in refinancing their debt when will come the recession. We're starting to look at the following questions. The current dividends, which in a way have replaced as regards the return of interest in terms of paying off for the savings, are they sustainable? We are seeing in this regard that the coverage of dividends has strongly diminished. It has moved from 3 in 2010 roughly to about 2.3 in 2018, which means, in other words, in good French, that profits are only twice superior to the dividends distributed, and this ratio is slumping in case of a recession. The significance of negative-based bonds should be a warning. About $15 trillion, in other words, 15,000 billions of bonds. State and companies now include negative rates, and this decline has gained momentum since the beginning of 2019. It is reflected in a considerable rise of the value of these assets, and this bubble coexists with the belief of the markets nourished by the central bank, according to which low rates are there to stay for a long time. However, and that's the second and last part, I reassure you of my statements, this monetary policy, which I'm criticizing, because it's very much easing, as it promotes the productive investment and the growth factor. Sometimes we believe that a non-conventional policy with negative or zero interest would promote investment. By definition, the financial conditions would be more flexible. It stands to reason. And let's look at things more closely. First of all, what was the performance of investments, generally speaking, for the past few years, ever since we've had such low rates? The trend in investment was quite disappointing. It can be characterized in the following manner. The level of investment that is non-residential, gross, in advanced countries in percentage of GDP has significantly declined. It has moved from 10.5% of the GDP in 2001 to 8.5% recently, which is a considerable drop. Growth of capital remains low, because if you take a snapshot of the stocks of investments and if you see that they have diminished during the period of low rates, in other words, it means that the new investment flows are not sufficient to make sure that that level is maintained. with regard to the rise in non-tangible investments, which contribute the most to productivity gains, that rise also is around 3%, which is also quite less than at the beginning of the years 2000, where it stood at 6% all in all. The contribution of these capital stocks to the potential growth remains historically weak despite interest rates that are very low, and perhaps because of these low rates which have been prevailing for over 10 years now. So I have some graphs that unfortunately are very so clear and explicit that it's too bad that I cannot share them with you. Now, a few observations on an empirical level. Statistics show that growth periods in terms of investment have always been with interest rates that were positive in actual terms. I haven't seen any exception to this historical rule. If we look at this correlation over the long period in the 19th century, which was a period where investment was very dynamic, where it was had a return of about 5% on real terms, on average, I mean that these correlations have one thing which is stable and robust that we shouldn't discard. What occurred that could account for that decline in interest rates for several decades? People mention quite rightly the phenomenon of the secular growth of the aging societies that have fewer productivity gains. They invest less. As a consequence, there's lesser pressure on available resources and a lower inflation. It's also said about the global savings glut, which causes structural excesses of the current payment balances of some creditor countries such as China, who amplify global liquidity, and this leads to them piling up reserves who buy dollars in order to make sure that they remain competitive with regard to the dollar, for example. All these phenomena have contributed to interest rates diving more on a global basis. However, let's not overlook the fact that another decisive factor results from the monetary policy itself. For the past 20 years, the Fed has systematically implemented an actual negative interest rate policies for these Fed funds since the early 2000s. If you look at the period from 2002 to 2018, you can see that with the exception of 2006, 2008, and 2018, the prime rate of the Fed in actual times, that is stripped out of the inflation of consumer prices, have been negative for 15 years, which contributed to the push of global debt and to the crisis.
And we know very well that it is the policy led by the Fed which is guiding the world and pushing the other institutions to follow lead, even just by wanting to follow the lead of the dollar. Now, let us look at the economic analysis, which can look at the relation between the negative rate and the zero investment level. Of course, low rates goes to the advantage of the debtors, individuals, companies, and governments, with a lower service of the debt, with a considerable transfer of savings to the debtors. Now, this improves situations on the side of debtors. Does it translate into an incentive to go higher into debts? To a certain extent, the answer is yes. Private and public debt keeps increasing since the crisis in 2008. The rising indebtedness of governments and non-financial corporations has been significant, similar to the indebtedness of households and the real estate bubble that has led to, all in all, global debts increased by 80% since the crisis. And no one finds this worrying. Now, what about so-called productive investments? This is the right question to ask. And this is when we should be talking about the liquidity trap. When interest rates come close to zero, it is difficult for a central bank to go much lower, right? This is what we call the zero lower bound, and the ECB has applied a negative policy rate of 0.05% for the reserve deposits it holds from the commercial banks, but it is difficult for the ECB to go even lower. And in fact, the profitability levels in the banking industry is directly impacted by the existence of this tax on their reserves. If the ECB were to go lower than 0.5%, the banks would be required or forced to recoup this tax on the deposits of their clients. And such a taxation, which is partially being applied to high deposit amounts for countries like Germany, Switzerland, Denmark, and Italy, would be very unpopular. And especially in France, for example, and would reduce the consumer spending with the households being taxed. And this would go counter to the desire of the authorities to prompt domestic demand. Now, the response by unconventional policies to these difficulties as follows. In order to keep reducing the real rates and to escape this zero lower bound issue, the only solution would be to provoke a hiking up of inflation by going systematically into monetary expansion. But there resides an issue here. If the rally of inflation and demand proves to be slow, which is the case for the reasons of concerns for the future, the fear of a recession due to the trade war with some structural factor which slows down growth and inflation, with a preference for liquidity assets which weighs down on the inflation rates. So where could this rally, this recovery come from, which is much desired and much awaited with respect to demand? So it's becoming a circular kind of logic. Not enough inflation, let's go into more quantitative easing. But if it's not enough, and it won't be enough to trigger an increase in the much desired inflation rate by the central bankers. Now, what can be done? This is when we start talking about helicopter money, which would make it possible to directly credit the individuals with central bank money, with very much uncertainty that this money would be spent and not saved. The core issue in the monetary policy is that there is a preference given to liquidity. This was Keynes' nightmare. Basically, most of these wizard apprentices make extensive references to Keynes. And Keynes, talking about the interest rates, has been very cautious, saying that if you bring the interest rates at too low a level, you will foster the pursuit for pure liquidity. And if you encourage the pursuit for pure liquidity, you will have few investments and less growth. And this is exactly what is currently being happening here. As investments by way of purchases of securities is guided into by way of negative rates, the investors and savers don't want to go into low returns or negative returns, and want to keep those most liquid instruments which are not impacted by the negative rates. I can stockpile 100 euro banknotes under my mattress. It won't give me any return, but when I want to use them, they still have a value of 100. If I buy government bonds, the value will go down to 95%. So in the conventional trade-off that savers do between yield, risk, and liquidity, the notion of yield has lost in significance in the context of negative rates. The arbitration, the trade-off is no longer in between the liquidity and risk ratio, and as can be observed in a chart, which unfortunately I cannot show you because it is quite telling. The reduction in govie interest rates have been accompanied by the very strong strong drop in the returns of the liquid assets. But such a preference to liquidity, which was what Keynes didn't want, has been diverting the savers into long-term investments. Obvious, Watson, isn't it? Now, the risk with this situation in which we are engaged is that asset bubble proliferate with respect to equities, bonds, consumption loans, debt funding of real estate, purchasing zombie companies, and so on and so forth. We are in a situation of a preliminary crisis. This all-out pursuit for yield has led to a deterioration in the quality of financial assets. I told you that we keep increasing the level of debt, but this debt is of lower quality, and the BBB bonds, which is one notch up the junk bonds, account for more than 50% of all investment grade bond outstandings, which is a perilous, unprecedented level. And debt issued by non-financial corporations in the US reaches more than $9 trillion in between, against $5 trillion in 2008. That is up 80% in just 10 years. So this explosion of the debts of non-financial corporations is the result of these monetary policies which were activated in the last few years and which have maintained the interest levels at historically very low levels. This debt level takes the form in many occasions of securitized assets, CLOs, which investors the world over love as they seek yield in a world where there's no longer yield to be found, and generate recessions, and the destiny of many companies which are too highly exposed to credit risk will be jeopardized and at stake. The risk is very well known. This is the risk we have experienced in 2007 and 8. That is an increasing in the size of bubbles, which at long last blast with the financial crisis following suit. So pursuing a zero interest rate policy for too long favors speculating into risky assets, lowers the risk premiums, and generates financial bubbles. And this diverts investors from what I would call real productive investment projects, long-term investment projects, which are indispensable for the real economy while making the financial system more vulnerable. Committing to a risky project with a risk premium of about 6 to 7% versus second option, buying back one stock with a 0% credit. You know, in between these two options, it is highly tempting for a company to go the second route. And this is what we've been seeing across the world today. And again, I'm sad I can't show you my graph, but you would see if I were to show it that the stock purchasing programs have been increasing exponentially at the very time when government has been telling us the world over that the funding of the energy transition is a must-have. Let me conclude now. We need to understand here, if we operate in the financial world, that we are in a moment of dilemma with respect to monetary policy. The monetary policy has come to its limits. It has come to a dead end. It has been called upon by the central banks to try and prompt growth. But we have come to the zero limit arithmetically with respect to interest rates by pursuing a 2% inflation rate target, which is unreachable for very valid structural reasons, which I've already mentioned. The central banks have been in the mind of the public opinion, embedding the idea that the interest rate will remain low for an indefinite period. Some central bankers have been heard to say that they would stay at a very low level for a very long time, 10, 20, sometimes said 50 years. This low interest rate landscape has a very depressing effect, and the analysts conclude that the growth prospect will be very gloomy for quite a while, and this squeezes entrepreneurship. So the long-term rates are lower than the short-term rates, which was the contrary in the past, which is less the result of a structural turnaround, but it is the result that the general public considers and concludes that the central banks believe that they won't be growth anymore, as they can't reach this magic 2% target. So setting unachievable targets comes with a very high psychological cost. Setting the target closer to the equilibrium, that is around 1 or 1.5%, would lead to a less systematically expansive monetary policy, which would generate less pessimism with respect to which would be a self-fulfilling prophecy. Whatever the arguments of the advocates of the non-conventional policies, we don't see any objective evidence that would demonstrate that the zero-rate policy will generate any kind of growth and investment. Thank you for your attention.